I think a lot of people have been surprised at how badly Bitcoin has done in this environment. But what has happened, especially since we first started doing our research, a lot more investors have become involved with it, traditional and hedge fund investors. And so, in a risk off environment, which is what inflation and higher interest rates has meant over the last year and a half, in a risk off environment, Bitcoin, especially this year, has succumbed to a significant deterioration in most asset classes. I mean, this is the worst bond market, believe it or not, since 1788. More than 200 years ago. We've never been in this bad a bond market, certainly through the first half of the year. The stock market, worst through the first half since 1970. And Bitcoin was doing well until last November. It almost hit 70,000. Now it's down to the low 20s. And yes, our confidence has increased, believe it or not, in our price target. One of the reasons is the partnership between BlackRock and Coinbase. We're seeing the traditional investment firms really being pulled by their clients into supporting or providing an infrastructure for institutional investing in the space. And by our estimates alone, if institutional investors put 2.5% into Bitcoin, that would more than double the price right now. We think that that's just one use case, though. If you look at emerging markets, which are being terrorized by inflation right now, talk about collapsing purchasing power, while 70,000 to the low 20s is a very big correction. What it does not change is the fact that Bitcoin is mathematically metered to top out at 21 million units. And if you look at most of the supply, we're at 18.5 million units, I think, are out there right now at Bitcoin. 14 million of those are illiquid. People hold on to Bitcoin. So if we now have this institutional investor base moving more aggressively into Bitcoin, at the margin, the supply relative to demand, there's, I think, only 3 million in liquid supply. At the margin, I think it could drive the price up much more than the doubling I've said, just because of that imbalance. Our confidence has increased in that forecast for 2030.
Cathie Wood is sticking to her $1 million Bitcoin price prediction and explains why she believes over the next 5 to 10 years we're going to see huge flows of institutional and sovereign wealth fund capital flow into the space. In her latest interview, Cathie Wood breaks down the macro landscape, explains why she believes we're going to see a huge pivot and explosion in crypto and innovation, and finally why, contrary to popular belief, she's actually hugely risk averse and her biggest learning is to take chips off as risk increases. Make sure to stick around to the end of the video where Cathie speaks on how her firm is currently in wartime mode and why her conviction for disruptive innovation has only increased with this year's drawdown. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
Best investment is Bitcoin. I remember when we first did our work on Bitcoin with Art Laffer, my former professor. I remember saying that it was $250 at the time. And we were doing this white paper. Chris Berniski was our analyst at the time. And when we got to through the white paper with Art, I looked at him and I said, oh my gosh, it can serve the 3 roles of money. It could. It's already serving as a store of value, but how big could this be, Art? And he said, well, how big is the US monetary base? This is the first global monetary system, rules-based, in history. It was $4.5 trillion then. This was $250, a $6 billion market cap, to 4.5 trillion as the potential TAM. Today, that would be $8.5 trillion. And I went out, I became the guinea pig for it, for ARC, right before, to make sure all the plumbing worked with GBTC at the time, and put my own personal money. And then, of course, ARC followed very quickly at around the same price. The worst investment, probably, I felt very responsible at the time. I was at Jennison Associates, and I was that adventurous analyst who was willing to go out and look at Mexican stocks and Chinese stocks. And the worst investment, we had loaded up on Mexican stocks. I was the prime analyst, and I did not believe that Mexico would devalue, that because the leadership was saying they would never revalue. We didn't take any of the risk off as that risk was building. And that's the worst mistake I've made, I think, in my career. And it made the difference at Jennison between outperforming the big benchmarks that year and underperforming. We underperformed. So I felt very responsible. As an economist by training as well, I should not have assumed that the Mexican government would be able to overpower global investors who were fleeing. And it was just a big mistake on my part, but an important learning lesson. If there are risks building, all you're doing is trusting the word of politicians. Well, don't do that. Take some risk off the table. Well, I will say one of the biggest challenges has happened here at ARC. So if during COVID, as innovation solves problems, from our low in COVID, this is the flagship strategy, and we were pummeled in the beginning but from that low point in April or May of 20 to February of 21, we were up 360%. And it was one of those times where we could do no wrong. No, we could do no wrong. And I said to the team, watch out. This is a setup. And so February of 21, we peaked through May of 22, and think that's the low, although don't want to jinx it. We ended up in a wartime situation because the traditional asset management world is not happy with us. We are giving away our research. We are basically saying the benchmarks are going to be underperformers during the next 5 to 10 years if these innovation platforms disrupt them the way we think they will. We're out there in the open, in media, social media. I think that a lot of people were happy to see our initial descent. And then we had these memes going around. Oh, this is just a replay of the tech and telecom bust in the early 90s. And so they were drawing our flagship quotes against the NASDAQ back then. And it looked pretty similar. And so there were algorithms out there, just one-way street, And so I basically said to our team, I said, we're in a war. This is a ground war. This is what we're going to do. We're going to start publishing pieces about benchmarks and how they do not expose investors to disruptive innovation the way we do. We're the new NASDAQ. We started publishing our models, more of our models, and then doing videos around them. And we were just out there all the time in the media. I was writing pieces as well, tweeting away. So we just took it head on. When you see someone on TV constructing an ark with little animals in it and then pouring whiskey or whatever and basically saying they're drowning, first of all, there's a lot of bearishness in the market when we got to that point. And I think it's not too long thereafter that we bottomed. So a lot of haters out there. Wartime is an apt description of what we've been through. We're still battling it. And I think when all is said and done, that the pendulum towards benchmark style investing, if we're right, and if we win this war, will swing the other direction. I founded ARC for two reasons. To focus exclusively on disruptive innovation, because what I saw happening in the traditional asset management world was a shift towards passive or benchmark sensitive strategies, which are all backwards looking. The companies that have high positions in the benchmarks are there because of past success. And if we're right, and the traditional world order is going to be disrupted completely during the next 5 to 10 years, that is not the right way to invest. And yet, most management teams couldn't believe there was a portfolio manager who did not want to have anything to do with the indexes. That was one reason. And then the second reason I knew I had to start my own firm was to add new dimensions to research. So in the traditional asset management world, compliance officers will not let portfolio managers and analysts say very much, if anything, about their work on social media. I knew the rules were changing. The SEC was drawing up guidelines for social media, social marketing, and now social distribution. And I knew that this was the right thing to do, to give away our research, to share it, because of what I told you before. There's so much inefficiency in the traditional markets when it comes to research and investing. They're not doing enough research on truly disruptive innovation. And I knew that our stocks were disadvantaged because of it. So give it away and basically develop relationships with people who are also passionate about innovation. And it's a win-win.